Hi, it's Baxter, Scruggs Mortgage Company. I want to give you a quick update on interest rates. So, senatorial races for Georgia back at the beginning of March. So we're talking about 5 weeks ago now, 5-6 weeks ago. When that went to the Democrats, interest rates pushed up for about a week. And the concern was more stimulus, higher stimulus, more government spending, more government borrowing. All those things are seen as inflationary. So the concern was all the numbers coming out of Washington would be, higher amounts, more stimulus, more borrowing, the whole thing. Not good for interest rates. They moved up for about a week, and then they calmed back down the next couple of weeks, and they've kind of been moving sideways since then. But going into the end of last week, going into President's Day weekend, Friday wasn't a good day, and then Monday was a holiday, and then the market just blew out on Tuesday, and it was a really bad market where you can tell it's shifting, and this whole week has been pretty brutal for the mortgage bond market. So there's been definite upward pressure on rates. A couple of reasons. One, senatorial race in the Senate is run by the Democrats now. Number two is the Fed has been doing whatever they can to to keep rates low. But if you notice, short-term rates, like the T-bill rates, have been creeping up. They went from like 0.6 to 0.8 to 1.1, and I don't know where they are today, like 1.3 or something like that. Those rates have been going up. The Fed's been trying to keep mortgage rates down by buying up mortgage-backed securities at unprecedented rates. But and if it weren't for the Fed buying mortgage-backed securities, mortgage rates would probably be, 0.5% higher right now than they were. So they've kind of artificially held rates down. But the Fed's kind of losing that battle a little bit and keeping long-term rates down as short-term rates push up. And then also a lot of the things that went into causing rates to drop, the pandemic, uncertainty about the economy tanking last year, shutdowns in states, economies, things like that. Those things are starting to unwind now. You've got the vaccine that's starting to take hold. COVID cases are dropping. Economies, the expectation is just going to open back up. A lot of pent-up demand. A lot of people want to do a lot of things, travel, whatever, spend their money that they have, their stimulus checks. So all this stuff is seen as inflationary, and also it's seen as unwinding the whole reason the Fed had to lower rates in the first place. So definite upward pressure in rates this past week. And so I think we're kind of, unless something changes here, we're kind of saying goodbye to some of the all-time low rates that we've seen over the last 6 to 9 months. And it's going to settle in at somewhere above those rates. So definite upward pressure on rates right now. Where it stops, we don't know how much effect it has on the market. Eventually it's going to have an effect on the purchase market. But right now it hasn't gone up enough to really affect demand or anything like that. But that's some interest rate update. If you have any questions on rates or anything to do with home loans, feel free to give me a call. My number is 760-497-7705. Thanks.